Welcome to the Seek Insights online event. This platform is a learning series designed to assist entrepreneurs and professionals in learning and development, as well as providing a platform to interact and engage the top 3% business, marketing, and technology talent in the world. We would like to help you access rare insights so you can thrive in your industry. Today we have Keet Van Zyl, who will be speaking around scaling your business. So the time will come when you need to take a serious look inside your business and see if you're ready for growth. Scaling your business is all about setting the ground for facilitating and promoting growth in your company. It means being able to expand without being inhibited, and it requires planning, some funding, and the right systems, staff, processes, technologies, and partners. So today we'll be chatting to one of South Africa's top venture capitalists, high growth venture capitalist, venture investor, Keet Van Zyl, partner who co-founded the growth equity fund manager, Knife Capital. Keet has a comprehensive investment and bank experience. He's worked at industry-leading international firms such as Procter & Gamble and Investec in specialized finance. Before joining HBD Venture Capital, he was instrumental in establishing various private equity funds in the Southern African region. In 2020, he co-founded Knife Capital to continue the active management of HBD's South African investment portfolio and build South Africa's fast-growing investment industry. Thank you so much for taking your time today, Keet. That's quite a lovely profile, an impressive profile that you have. For yourself.
Sounds interesting, but I guess
Yes.
I have been fortunate to really work with some great people through my career and some great companies, and learned all the way through corporate and through working with HBD, Mark Shuttleworth, but none so as the scary truth of starting our own company. You know, Knife Capital was also a startup on the 1st of July 2010. In fact, it's supposed to be our 10-year birthday party on the 1st of July 2020, and it will be, but we wanted to have a big splash. Now we're going to have to do it online. But yeah, I mean, one learns a lot about how to hustle, scale, get cash flow from somewhere when you suddenly jump off that cliff and no one else is paying your salary but yourself.
Sure, that's been quite some time, and happy birthday and well done for staying afloat for the last 10 years. We'll be chatting around how to scale your business, and I think for those of us who have joined, what does it mean to scale your business?
Yeah, I think the first thing to really think about is, do you have a scalable business model? So scaling, one mustn't confuse just, good growth and what those growth rates should be with real hockey stick type scaling. So if you are growing your business, so it depends on your business model. It also depends on the life cycle of your business. It could be in the early stages where there's higher growth, or it could be a mature type business where you maybe have 10-20% year on year growth, which is phenomenal. But if you are a scalable business, it basically just in the short version is that your revenue can ramp up much higher than or quicker than your expense base can. So examples of scalable business models, and that's why generally venture capital companies also like recurring revenue models, like software as a service models. So let's say you have a piece of software which you can deploy, takes you, so many man hours to develop, and some coding and et cetera. And if you then deploy that software to solve a specific problem into one company that uses it and pays you on a monthly basis for it, that's the same. Whether that then becomes 2 companies or 10 companies or 10,000 companies, the actual cost of developing that product doesn't increase at the same rate as what the revenue increases. And that's sort of perfect scalability, I guess. When your expense base stays fairly constant, there's always going to be, additional marketing people, support people as you bring on clients. But yeah, so back to the first question, that's scalability. And the question is, do you have a scalable business model? And there's nothing wrong with not having a scalable business model, but which you can then turn into a scalable business model. An example of that is a coffee shop. So let's say you start a coffee shop. You start one coffee shop and you call it Vida E Cafe. You have a certain ethos in terms of how people need to dress, how they need to interact with clients, They really need, the kind of coffee and meals and stuff that you make. And coffee shop is not scalable. I mean, it's a coffee shop, so you can only really sell X coffees. You can maybe expand that to add other offerings, until you really put a franchise hat on to say, hang on, am I building a brand which is in coffee, or am I building one coffee shop? And that's sort of the difference in mind shift. Is even non-scalable businesses, like an example of a coffee shop, can be scalable when you actually bottle that into a franchisable thing where other people then say, oh, hang on, I like what you guys have built here. And you say, well, let me sell you the training methodologies, the ethos, the dress code, the brand, the colors, the recipes for the food. But you provide the capital for doing that. And in the end, you're actually selling much more than coffee. You're actually building a brand around that, which is again the difference between scalability and Keets coffee shop down the road in Cape Town, which stays one coffee shop. But yeah, so then when you come to growth businesses, and I think that's maybe something that's wrong with the lure of entrepreneurship in the tech environment and all this hype and substance, well, hype versus substance around it all. It sometimes feels like there is just the sexiness around these tech entrepreneurs that build unicorns and off you go, versus actually just saying, hang on, building good old sustainable businesses that just grow year on year, employ people, don't take too much risk. And sometimes people label those as a lifestyle business, which can sustain, a couple of founders' lifestyle. But yeah, building a high growth lifestyle business is actually a much less risky strategy. And then you're just focusing on good sustainable growth versus this hockey stick scale of, say, how do I take it to international markets? How do I scale?
You touched on the difference between a scalable and a non-scalable business. And that leads me to the next question. What are the actual critical steps to scaling your business?
Yeah, so there are a few critical steps. I think, again, once you've determined that it is something that you can take and ramp up the expense base, it's a few steps. I think the first step that specifically Knife Capital is always a little bit on about is, and it's good old goal setting, but you need to confirm your end game. What are you aiming at? We always, in our business model of venture capital, talk about exit-centric business building, which basically sort of means in our world is we go to work to build businesses. We don't go to work to sell them. We build them. But we build them with this mindset in place to say, well, let's build them with an exit in mind, a goal in mind. And our goal is generally making them exitable, meaning someone else would want to potentially buy this business. You can keep it, don't have to sell it, but make it attractive to people. So yeah, step one of scaling is know what the end game is. I mean, if you want to, whether it's a particular growth rate, 30%, 10%, 100% year on year, understand the life cycle, but confirm the end game. Then once you do that, make sure that the business model supports that. So you need to increase the profits, much higher than in terms of your expense-based revenue and all that. So when you sell that proverbial one unit for X rand or X dollars, and when you sell 10,000 of those units, it can't be that you marginally just increase the profit margins. It needs to, your business model needs to stack up. Next step is you really need to understand your target market. Generally, entrepreneurs look at this a little bit one-dimensionally in our experience. When you look at what is your total addressable market, how big is the market, and how much of that market can you service, and how much can you execute within that market, and what are the channels to sell. You really need to understand those things, because one of the things, as many of you I know on this, or some of you on this call are experts in that, in terms of market access. Really at the end of the day, nothing happens until you sell something, and to sell something you need to sell it to someone, and you need to understand how big potentially that market is, because if it is really a niche market that you can only sell that product to so many people, well, then it's again not that scalable unless you really make it a premium product, which has a high price tag to it. But that's different. That's a different business model. Key relationships is the next step. Find that network effect, that the more people that use the product make that product more valuable. If you think about a company like Facebook, Facebook wouldn't be that valuable if there wasn't a network effect around it. So if the two of us had Facebook, we would be able to talk to each other. We can post photos. We can do exactly the same things, but it's not the same as a couple of billion and all your friends having Facebook, because then that network effect starts becoming into play that you almost have, and that happens to businesses like Instagram, WhatsApp, and those things. It becomes much more valuable with this network effect as the more people that use it add to content and make it usable. Next step is to build traction, different traction verticals that one can build, and really looking at increasing that. And traction just basically means momentum. So you need to start somewhere to say, what are those traction verticals that I'm building for the scalable business? And that could be what is the drivers behind the revenue? It could be number of widgets sold. It could be number of business to business clients. It could be number of awards won, number of patents registered. If you're a university spin out that really need to make sure that the technology is licensable, or whatever that metric is around traction, or let's call it momentum. You need to be sometimes fake it till you make it a little bit, but you need to show that there is momentum. I touched on it a little bit earlier, but be prepared. Again, something we often preach is to say that interesting things happen to interesting companies, and we see it time and time again. So many entrepreneurs come crying on our shoulders saying, listen, I can't believe this has happened to me, but I got a term sheet from an investor that wants to acquire the business. And I actually went for a sales call, and I felt, listen, this is a good integration and maybe we should buy you guys. Or just someone that wants to merge with you, or you two competitors decide, hang on, maybe we should actually collaborate and form a merger or something like that. So, but that stuff only happens if you've got something to sell, you've got traction, you are scaling. And in that scalable journey, these things happen if you are prepared to pounce. And that means have your marketing material ready, have your data rooms ready, meaning the documents that people would want to look at, your structures, your policies, make build an asset of value and be prepared to sell it. To do that, you need to have next step corporate governance. A lot of a business doesn't have life. I mean, it's basically just a SIPC registered thing in South Africa. So, but that thing needs certain board decisions, shareholder rights, reporting requirements, and you give this life. And the way to give this scalable life is to really pass that knowledge and structures on to middle management and the worker bees, to really be not confused about what the business stands for, what's the purpose, what are we building towards, what decisions can I make, where am I empowered to do something, when do I need a manager to sign off, all those systems. And you can only scale a business based on processes and systems. And lastly, funding. Remember, you are speaking to a venture capitalist, and I will always throw the fact in there that sometimes there are windows of opportunity that can only be taken advantage of with extra resources in the form of some growth capital.
Very insightful. You spoke with the last point on funding. So with a scalable business, it's obviously something that has the potential to grow. It's already in quite a stage where it's making a lot of profit. If you're an established business, how do you raise money?
Okay, so maybe just to quantify or qualify that, you don't have to make profit to raise money. I think when you make profit, if you're an established business, if that is the question. So maybe I should answer the question two ways. If you are a new startup or an early stage business without sustainable cash flows and profit and those things, then your funding options are less. If you look at it on a continuum, as the business grows, the risk goes down, because now you can, all those promises that you have to make to investors, that this is what I'm going to do, I'm going to grow into this market and so forth, and I'm going to launch this new product vertical, are now sort of coming true. And the more assets you have and the more cash flow you have, the cheaper finance you can access, because a loan from a bank especially with the prime rate at the moment going down and down, is which is not a good thing necessarily, but anyway, that's cheaper than necessarily that sometimes selling 30% or exchanging 30% of your business to a equity funder. So if you are a new business or an early stage business, unless it's your own funding or some funding from friendly fire, friends and so forth, then that funding needs to come from equity funders who don't take security, that come in as a partner of the business. And that's sort of one of the reasons of the birth of venture capital, to say, okay, hang on, we're not going to bond your house. There's no repayment schedule. If we put in 10 million rand or 5 million rand or $1 million into this business, and we end up going after a target market and realize that the market wasn't there, or the product is wrong, or we don't scale it properly, then we all lose our money. And if we do it in ethical ways, then we can all still have a proverbial glass of wine afterwards and lick our wounds about the days when we tried to build this business, and that's okay. But if you look at established businesses, the upside is you can gear that business with loan funding. You don't have to actually exchange equity. So it's cheaper, it's better, provided you can pay those loans back. Because if COVID happens and suddenly, or unexpected circumstances, and suddenly your cash flow dries up to service those loans, typically you have signed surety behind it, or you have bonded your house behind that asset, because banks, and remember, I used to work at a bank, are in the business of, they're not in the business of taking your house or taking your assets or perfecting on those securities. They're in the business of lending money or putting that money out and getting that money back. So you need to prove affordability of paying the money back. But that's so how do you raise business if you're established? How do you raise funding if you're an established business? Well, speak to your banking partners first. Speak to alternative finance partners, which are more softer finance, like business partners. If you happen to be an empowered company, there are other avenues that you can use for empowerment funding, and those things generally. But if you are an earlier stage business, then it lends itself more towards the seed funders, the venture capitalists, and the angel investors, which are becoming a really big play, specifically in Africa, around higher net worth individuals that want to get involved in alternative assets by augmenting their wealth and expertise behind businesses that they can control, versus buying a listed share that you don't have direct control over the outcome.
This is a bit of a sideways question. You mentioned venture capital and seed funding for or businesses that haven't yet seen any sort of profit or in their early stage of the business. What have been some of the trends specifically in Africa with venture capital and angel investors that you've seen?
Sure. Well, there's a lot over the last number of years, there's been a big positive trend towards new funds launching. So a lot of momentum has swung towards different, let's say 10 years ago, there were only a number or a handful of so-called risk funders or venture capital funders. Now there are really quite a lot. So that's there's a robustness in the funds raised or funds under management that's available. I think that another trend is a lot of international funders have really looked at partnering with local funders and getting involved in on the continent. Another trend which sort of interlinks with that is more acceleration models. And I mean, there's a whole different topic one can have about the benefits and drawbacks about good and not so good accelerators, but incubators, or just let's just call it support structures entrepreneurship development programs behind entrepreneurs, which then partner with international funders to help scale the businesses internationally. Because think about it as more soft landings. If you have a UK-based investor or accelerator partnering with local ones, and then businesses want to grow there, they already have systems, relationships, and potential access to funding that side. In South Africa specifically, there's been, and maybe some other countries around Africa, but specifically more legislation borrowed from countries like the UK and the US, and that more around incentives for funders. So there's something called a Section 12J of the Income Tax Act, venture capital companies that have established. But that just in plain English means in many countries now, in South Africa as well, for the last number of years, investors are almost incentivized to put money behind startups because they get a tax break. So you invest in a company that's accredited, and you can deduct that money from taxable income. And that basically is to almost de-risk a very high-risk investment class because of the knock-on effects of it. It fosters innovation, it helps with growth, and it increases the tax base in theory, because you're creating new businesses, which is the future tax base. And then maybe another mega trend is around angel investors. There's a lot of focus on angel groups. A lot of them focus on women. Some of the new funds also focus on women entrepreneurs, and that's a very good thing because of the many good elements that they bring to a diversified management team and founders and so forth, which has been neglected in the past. But yeah, I think that there's a lot of focus on training angel investors on how to invest, because typically, and we find it as well in our business model, if you're a high net worth individual, maybe you've made your money in property development, or you managed to buy Bitcoin at the right time, or you're a listed company director which has a big payout, and now you want to invest in an early stage startup because you do have the asset base to do so and the willingness to give back. You don't necessarily have the skills of how do I value these companies? What value do I add? Do I take a board seat? Do I take 70% or do I take 15%? How do you value a company that doesn't have profit? Is it worthless? So a lot of training around answering some of those questions to create responsible angel investors is also happening.
All right. That's quite interesting. I mean, it is quite new, the whole concept of angel investment. I know it's quite a big buzzword in Cape Town. Just angel investment, tech, there's the Silicon Cape, and it's all very exciting. But I think just, I just wanted to find out, in terms of action, where that's actually, where that is. And then from a perspective of Knife Capital, what are maybe some of what do you look out for as a business and as investors in terms of investing into a company?
Oh, look, I mean, there's a few things around testing that business model for scalability. But if you summarize some broad themes, it basically boils down to three things. And the first thing is the business itself must have a very good product or service. They must be good at what they do. And I can't emphasize that enough, that a lot of what you talked about, the hype around startups and Silicon Cape and so forth, you need to also take a good look at yourself. If you are a startup, am I really good? Am I in the top 20% on the 80-20 rule of what I do? So is my product really that differentiated to others? In our accelerator model, Grindstone Accelerator, we've just going through the applications for our next cohorts, and we literally have 3 businesses that are doing exactly the same thing for exactly the same target market in South Africa. And that's fine, but not all 3 of them are going to make it. So one is going to be the one, and the other 2 are going to either have to amalgamate or do something with, or find a different niche in terms of that thing. So is it differentiators? But anyway, one key theme: be awesome at what you do, be great at what you do, have a differentiator, and the product or service must be amazing, and it must solve it must be a solution to a problem. It mustn't be a solution waiting for a problem to solve. There must be a real pain point in the market, and that. So awesome product. Second thing is large addressable market for that product. So, you can have an amazing product for a particular small client base. It's not going to really hit the lights out. It's going to really solve a particular need for that small client base, but not for a large addressable market. And then the third and most important thing is the ability to execute. So the entrepreneurs, they don't have to be necessarily good at everything, because that's why you particularly raise funding to appoint a marketing manager, or the business is big enough now to have a financial director, or you need to have help with business development or market access or technology team need to grow, whatever. But entrepreneurs need to be able to execute. So if you overlay the ability to execute an amazing product into a large market, that's where the magic happens. That's what we look for.
Awesome. And you mentioned the, not having differentiating factor being one of the causes that some businesses don't necessarily flourish. What are some of the other common causes of business failure?
Look, there's been some studies done around this. I think it was the Startup Genome Project, which basically looked at what are the reasons for failure. Is it because businesses don't generally have a lack of funding, or is it because entrepreneurs don't have enough mentorship or skills? Is it access to client base? What is the thing that if they did better, that they would then, the failure rate would go down and the success will increase? And they found that it's actually not one thing. There's about 5 things. Well, the actual reason for failure is the fact that companies fail to grow or scale these 5 things in proportion to each other. And that's sort of the thing. So the first thing is customers. So do you have enough customers? Do you focus on that customer base? I mean, we touched on that. Next thing is product. So do you have the right product for those customers? Next one is team. Do you have the right team to execute in that customer base? The business model comes next, and the funding. So if you have the team, the customers, the funding, the business model, and you execute these five things in proportion to each other, that sets up the business for success and less failure. Problem is, to put the glue between these 5 elements is a skill, and it's a business skill. And that is where it becomes a little bit difficult. So if you have the business skill to grow funding, business model, team, product, and customers together, then you avoid failure. I think there's also a question around this. Tom, like, do you think there will be a change in paradigm regarding entrepreneurs and failed ventures post-COVID, or the stigma of a failed venture will prevail? Africans can be quite unforgiving and quick to shame people that take a punt and fail. Yeah, I mean, I think that is a good question. I think that a lot of the COVID failures are dressed up as a COVID failure, but it actually sometimes was always going to be a failure. Think of SAA, for example, just to pick a random something out of the thing. Are they going into all sorts of business rescue and all these things because of COVID? People are not flying around now. Definitely a catalytic contributing factor. Or was that business always doomed to be something is not working, because you can only lose so many billions of rands for so many years before you can kind of have to admit to yourself that it's maybe it wasn't COVID that killed that one. But one of the key problems with our entrepreneurship culture in South Africa specifically, to talk about, is this unforgiving nature on the stigma around failure. And I'm definitely not one to say let's go out there and fail is a good thing, and fail fast if you fail. I think don't fail if you don't have to. It's much better to not. But there is that stigma, around it, and it's also inhibiting our entrepreneurs, because a lot of entrepreneurs would-be entrepreneurs would rather be safer in a corporate environment. And I'm not knocking corporate environments. I loved my corporate skills and environment there, but should I have stayed a banker, or should I have been a lawyer and being absolutely secure of a salary slip for the rest of my life? Or should you jump ship and be an entrepreneur and maybe fail? And the problem is, once you've once failed and been on a blacklist of, maybe being sequestrated or something like that, unlike a country like America, where in the US there's a little bit more tolerance for failure. And I think it's just a across the board culture around conservatism, forward planning, and just like just really being more conservative. So will it change post-COVID? Because people say, well, hang on, that business failed because of this cataclysmic cluster of an event called COVID, which definitely taken business down. I think in certain verticals, yes, absolutely. I mean, if you had to, and I do have some friends in that industry, if you have a restaurant and the restaurant was going quite well, and then all of a sudden you were not allowed to have clients for 3-4 months because it's just something that you couldn't, for whatever reason, put online. Maybe it's a high-end restaurant, and that restaurant goes into liquidation. I mean, if you're a great chef and a great team next year wanting to start a new restaurant, I think people will say, okay, hang on, we can exactly see why that restaurant failed during COVID. So yeah, it's a very good question. I think, unfortunately, I'm leaning towards the culture of failure won't change, but there will be some tolerance on some business models depending on what that was. Yeah.
The one question is, what impact will the lockdown, and I assume by lockdown they mean, this extended social distancing period, have on investments over the next 24 months? And how will that impact opportunities, particularly in South Africa?
Yeah, I think the evaluation of investment opportunities will be more robust as they were before, because I think that unlikely scenario planning event has now happened. So we someone sort of sometimes say, that'll never happen. I think now everyone's a bit scared of like, well, no one could have foreseen this. So one has to do quite a lot more scenario planning. It's like, well, what is worst case scenario, and what if worst case scenario happens? And it might not be, well, what happens if we have another virus? I think people there'll be a lot more stress testing of the business models of downside protection. So I think that also might impact investment instruments, downside protection from investments for investors. Just to say, look, we always invest with this upside, and the business will grow year on year, and this hockey stick will happen. I think there'll be a little bit more focus on the what if downside scenario. What if that does not happen? So there will be a bit of a focus shift. I mean, there's already a bit of a focus shift in the due diligences that one does and stuff like that. Will it impact over the next 24 months the fact that people are going to sit on more cash and not deploy? I think a little bit yes and no. Us as venture capitalists are a little bit worried that the funding lines will dry up for various reasons. We can only invest by getting pools of money from corporate investors or angel investors or whatever. There's no doubt that people are a little bit more conservative in terms of holding onto cash. We ourselves as investors are expecting to invest behind our portfolio companies a little bit more now, because some of your portfolio might have a great business model but now needs a little bit more time to execute that business model, some elements of rescue and those type of things. But the good news is, for large part, it's business as usual. I mean, only this week in South Africa, there's already been a few really good venture capital deals announced. Yes, they probably started those diligences and negotiations definitely before COVID. Us ourselves as Knife Capital are finalizing a due diligence on one company and starting another DD on another company. One of our portfolio companies is closing around with external investors. So, capital in this game can't sit still, because then there's a drag on returns, without getting too deeply into the business model of venture capital. But it doesn't help us having our 100 million odd or whatever it is to invest still lying in a bank account earning the kind of interest rates it will earn in the bank account, because our investors that gave us that money expect a return, and we have to give it to them or die trying, so and we can't be irresponsible about it. So you need to put the money to work. A lot of funds does or have funds to deploy, but it's going to be a bit more difficult, more robust. So just have your ducks in a row.
All right. And with that being said, Keet, would you say that there might be a shift? You spoke about, industries or companies that were already maybe struggling. I know, for instance, the media industry is, I mean, when I say media, I'm speaking specifically to print. Do you think there might be a shift in terms of obviously having your ducks in a row, but the kind of industry and the kind of product that investors actually are willing to get into?
Definitely. This will last. This will definitely have a lasting imprint on how people do business. Definitely conceivable that there will be less travel. I mean, you will now start saying, not because you're scared of the virus maybe next year, who knows how long this will last, but more you might ask twice, do I need to be in Joburg if you work from Cape Town twice a month, or can I maybe do it a board meeting that I would have flown up with ordinarily now via Zoom, now that we've all sort of tested and stress tested this. So there'll be lots more collaboration tools coming out. Online education. I mean, there's already announcedments of full-on online schools that are geared towards not homeschooling, but more online. Those type of tools, the ed tech businesses, and luckily, Knife Capital has invested in 2 ed tech businesses which are doing well during this time. So I think there will be telemedicine. Those type of things, online, e-commerce, food delivery. So one can really conceivably look at those lists of businesses that will benefit, and there will be absolutely opportunities for those, because what will happen is the big corporates will also start sitting in their boardroom saying, how do we innovate? How do we pivot, or how do we do things differently from how we did it before? And a lot of it will deal with technology, and there will be not more partnership or willingness to partner with startups, because not doing so is becoming more dangerous than doing so. You can't go with business as usual, so you have to do something, and that something needs to be innovative. So let's partner with the innovators. So there'll be lots more activity towards that, and definitely see it as a positive. I mean, I know it doesn't feel like it where we all sit right now, but if you do the research, and I'm sure we've all seen the tweets and stuff around it, but if you look at the businesses that have started in 2008, 2009, in the midst of the crash, that market crash at that stage, those things will happen again. Adversity breeds innovation.
Do you think the 12J sunset clause will be extended?
That tax incentive I was talking about, it ends in June 2021, meaning that no one that invests into a fund after June 2021 can get the tax break. So we've kind of got a year and a bit left. There's been a lot of lobbying and working with SARS and Treasury and stuff to say, it's been such a good thing. It's been untested. Yes, there might have been a bit of abuse here and there of people taking some gaps. Can we extend that? It depends, Guy, on can we prove that it has benefited job creation. Job creation, basically, it goes around that to say, well, what have we done as a 12J industry for investing behind SMEs, and what did that mean for the thesis of job creation and growth? If I'm a betting man, I would love it to be extended, because I think it's been a really good thing. I think it might be tweaked into a different format, maybe even a different 12. I mean, some other clause. So I think something will continue, but I think it'll look much differently. And how can be more effective for real small scaling businesses? Very simply, the scope of what 12Js can invest in is too broad. I mean, it's meant to be equity funding for SMEs, and people have got quite creative on what that means in various ways without going into that. But I think that SARS have been maybe, and Treasury maybe a little bit too vague about what their intention is exactly. So none of these things are illegal, and even they say so. But it's a bit unclear what the intention is. So if they can come out very clearly to say, look, these companies we want to invest in, these are the targets, this is your reporting requirements every 6 months or 3 months or whatever, just make it so that everyone wins. Then that could be more effective.
Thanks, Keet, for your time. And thank you to everyone that has joined us. Do you have any parting words for our audience?
Look, I mean, I'm always humbled by people wanting to, and especially, entrepreneurs wanting to really collaborate and listen, to just say, look, we're all in it together. Don't think the funders are not also having to really relook at our funding models and business models. Remember, the entrepreneurs are the key players. Without the entrepreneurs, there wouldn't be venture capital, which at the end of the day is just a commodity of a service provider and some money. So you are the main players as an entrepreneur. Act like it. Have faith, and be open and communicative with your stakeholders at this stage. People appreciate authenticity and honesty, even if it means I can't pay you this month, or this is how it's going to be. And finally, with COVID, and this is the advice we give all our portfolio companies and ourselves every day, is just make sure that you do things differently, but don't do different things, because I think you can't just pivot left, right, everywhere because you're desperate. If you have a solid business model, go down that path, but just tweak it and do it differently, but don't do something different.
All right, that's actually quite great advice. Thanks so much, Keet, for joining us
It's been fun.
And thanks to, it has been fun, and we've learned quite a lot.